There are a lot of common questions when it comes to mortgage qualification, but in case you didn't know, the answer to those questions could be quite different than what you might be thinking. I'm here today with Amber Lewis from Berkshire Hathaway Home Services. And Amber and I were talking the other day, and she had some great questions that I really thought would be great for her to share, especially since I've been doing so many fact or fiction episodes. So Amber, thank you so much for coming in.
Thank you for having me today.
And you had great questions. So the first thing I want to do, though, is kind of let people know these questions are going to be kind of general in nature because some will be slightly different for FHA, slightly different for VA, and slightly different for conventional. So we're going to touch on just general questions, and we're going to talk about the answers to these questions on the basis of what we consider to be traditional mortgages.
So some questions that I think would be beneficial for anyone who's getting ready to purchase a home or kind of starting the process would be what needs to be done to even qualify to get a mortgage.
So one of the things that always comes up is income. I mean, that's like kind of the starting point. And what's amazing is so many people look at income differently than I look at it for mortgage purposes, especially when it comes to things like commission, overtime, bonuses, and even 1099 work. So let's start with the commissions, overtime, and bonuses. Unfortunately, I need like a 2-year average of those to be able to use that as income. The problem is we don't know how often this money is going to be received. We don't know if it's seasonal. So we really don't have a track record. And when we're looking at income for mortgages, we need to look at stability. And I mean, it's a 30-year loan that most people are getting, even if it's 15 years. That's not a short-term loan. So we need to look at the long-term ability of this income to continue. So we have to have 24 months for that. Now, the other thing that comes up is 1099 contract work. And that's one that can really catch people. I had a technician, and he was in the job as a W-2 worker, and they offered him to go 1099. And he was like, wow, this is great. I'm making so much more money. But the problem is you have to have filed a minimum of 1 tax return. And a lot of times, if it's a new business, a minimum of 2 tax returns before I can use that income to qualify. We need to see what the expenses are, what's being written off, so that we really know the true bottom line of that income. So income's the starting point, and those are some of the variables that get people confused.
And then as far as if people have student loans or if they might have had a blemish on their credit, how does that work in getting pre-qualified?
Another excellent question. The student loans are a real biggie, especially right now. It was just announced that they may be forgiving some student loan debt, but the problem is they haven't actually forgiven that debt yet. So that's the problem. I have to deal with what are the facts that we have right now. The other thing is a lot of student loan payments have been in deferment for COVID-19. I still have to look at the payment though. So depending on which programs I'm looking at, I have to look at usually what it works out to be is anywhere from 0.5% of the balance to a full percent of the balance as the monthly payment. And that gets very frustrating for buyers because they say, well, I don't have to make payments right now. But again, we have to plan for the future because you will at some point.
That's great to know, especially right now if people still have deferred payments on their student loans. It's still considered when you guys are doing your calculations.
That's right. It's good to know. So let's now talk about those credit blemishes.
Okay.
Those can be a problem or they may not be a problem. It depends on how recent the credit blemishes were or how long out they were. I had a guy recently that was selling his house to buy another property. He had had late payments, but they were more than 2 years ago. So I was not worried about that at all. But he got a little lackadaisical when he sold his house. He said, well, you know what? I really don't need to worry about making the payment. It's going to be paid off. Oh, that was a huge problem. Mortgage payments that are delinquent within the last 12 months are a huge problem. So it really depends more on the severity of the delinquency and how recent it was. Bankruptcies, foreclosures, things of that nature, there's a seasoning requirement. For the bankruptcy, it can be anywhere from 2 to 4 years. And for the foreclosure, it can be anywhere from 4 to 7 years. So there's a lot of things we can work around, but it just depends on the recentness and the severity of the blemishes.
Okay. And then can you talk about with co-signed loans? So if there's one person purchasing versus co-signing if you're putting 2 people on the loan.
So for cosign loans, if I'm looking at somebody who has cosigned for someone, whether it's a property or a car or whatever, and I'm looking at their qualification now to buy something for themselves, they are still considered on that unless I can prove the other person has been making those payments for at least the last 12 months. So it's another area where people really need to come to me and let's look at the full situation, because sometimes it can be a big issue, especially when they recently did it, but other times it's not so bad at all. We just prove that the other person's making the payment and we're good to go.
And just to touch on that as well, so if you have buyers, for example, if I'm working with buyers that are spouses, two people, from the lending standpoint, can you look at both spouses, their income, whether they're W-2 or work off of commission, and decide to either put both of them on the loan versus focus on one versus the other?
It's a great question. And believe it or not, I tell people, here's what I like to do. I like to start out with both of you together to get all of the information. But I do exactly what you're talking about. I will look at them both together, and then I will say, well, what if we use this one, and what if we use this one? And sometimes it actually works out better. My situation is a good example. My husband's self-employed. We didn't need his income, and I said, honey, I love you to pieces, but I don't want to have to deal with your tax returns, so we're just not going to put you on the loan. When it's your primary residence, the spouse still goes on the deed.
Correct, right?
Yep.
And when we write the contract, both spouses are on the contract throughout the process, but then sometimes only one is going through the mortgage application process.
Correct. The non-borrowing spouse, the one who's not on the mortgage, does still have to sign the mortgage, but it's not the note, it's not the repayment, they just sign the mortgage. And we do that because state law requires that we notify them that a mortgage is being taken out. So that's the way of notifying.
And then another important thing when you're just starting the process, you want to purchase a home, is how much cash is needed to close as far as down payments or cash at the closing itself.
So the amount of cash is going to vary, of course, depending on the different programs. If you're a first-time homebuyer, you can actually get in with as little as 3% down. There's also first-time homebuyer down payment assistance, so that can help with some of those things. But I tell you where people really get caught up is they think that they don't have to have the cash until closing. And that's where the question and problem really becomes. Because I have to prove you've got the money to close before I can close. So we have to go through that whole verification process. The other thing is we have to prove that there's no large sums of deposits that came in. If there's a large deposit, you could have borrowed those funds, and that could be an issue with qualifying as well. So you can get in with as little as 3% down. You can get down payment assistance if you're a first-time home buyer, or sometimes you can, but you still do need some cash to close, and we have to verify and prove all of those assets before we can get your loan approved to close.
So you're checking on the cash to close or making sure that the buyer has assets. Are you doing that before they even start looking at homes, or while they're under contract, or multiple times throughout the process?
Well, believe it or not, it's multiple times. Yeah, we start at the beginning before they ever get started, because it's a conversation we need to have. And it may be a situation where we have multiple options for them to get the money. They may say, well, I might be able to get a gift from mom or dad. Well, let's check with mom and dad right now, because how much of that gift is could make a big difference on programs and what we're looking at as well. In some instances, they say, well, I can get this much money from mom and dad, but I'm still going to be short money to close. And we discuss, well, where would that money come from? Well, I have a boat. I'm going to sell the boat. So that becomes a method that we need to track then. You sold the boat, we get a purchase agreement on the sale of that boat, we show that you've a copy of the funds that you received, and we show that money going into your bank account. So we do in fact check at the beginning, and then as we're going through the process, we verify it along the way.
And then as far as a purchaser or a buyer, are they allowed to borrow money? You mentioned possibly getting gifts, but can they borrow money in other ways in order to make sure they have that cash to close?
You can borrow money, but it has to be borrowed against an asset. Now, there's some stipulations on that depending on the different programs. Again, FHA, VA, or conventional, but it is in fact possible to borrow money, and I have had borrowers do that. I had a borrower that owned a car, had paid it off quite a while ago, but they needed a little extra money to close. They were able to finance money on that car. They qualified with that monthly payment, and we were able to go ahead and close in that manner.
It's great to know.
So we had a chance to talk about income, we had a chance to talk about credit, and we had a chance to talk about cash to close. Those are like the three most important things that borrowers usually ask you at the time they're looking to buy a house. Thanks for watching that part of the episode, but stay tuned for part 2 because we're going to talk about, once you're ready, what are some of the things you want to do and not do. So thanks for watching. We'll see you next week.